What's up, everybody? It's your boy Orlando, aka King Smitty. Welcome back to my trading journey. And today I have 5 ETFs that's gonna help us start passive income. If you're on my social medias, you know I did say I'm gonna create a new portfolio with strictly ETFs. And these are going to be the 5 ETFs that I'm going to place in here that's going to help me start a dividend growth portfolio, mostly dividend growth portfolio, right? But before we get started, go ahead and hit that like and subscribe. I'm making my way to 500 subscribers. And I really appreciate everybody who takes the time to watch these videos. I love y'all. But for the first ETF I'm going to talk about is ticker symbol VOO, VOO, which is the Vanguard S&P 500 ETF. Year to date, it is up 8.62% year to date, and this tracks the investment performance of the S&P 500, pretty much. So it's like SPY in a sense, but being handled by Vanguard. It pays a quarterly dividend, so that's every 3 months you're gonna get a dividend payment, and annually you end up getting $6.36. So divide that by 4, and that's how much you'll get every 3 months. I believe it's like March. I think you get paid June. What was that? September or August, and then December is the 4 payments. And I believe all the ETFs I'm going to be speaking about are pretty much paying on the same month, on the same 4 months, 3 months, which is the ones I just named. So that's the first one. Ticker symbol VOO, VOO. Currently sitting at $471.43. Is it expensive? Yes. Is it worth buying? Yes, it is. Still. But I'm not saying you have to just go jump all in right now. I mean, markets are at all-time highs. So, of course, maybe wait for a pullback before you start building your position out. You know, you could buy fractional shares until you have enough to make a full share, and then you just continue buying. That's what I'm going to do. Of course, this is not financial advice. This is what I'm doing in my portfolio, and I'm providing this for educational or entertainment purposes, shall I say, not educational, entertainment purposes. So that's the first one. Ticker symbol VOO, VOO. Second one, VUG, VUG, Vanguard's Growth Index Fund ETF, which is up 12.43%, right? And this broadly diversified index predominantly made up of growth stocks of large U.S. companies, right? So it's focusing on a lot of the stocks that are in VOO, like the main holdings for both of these. I believe it's like Amazon, Nvidia, Google, Apple. I think Microsoft as well. So that's like the leader for both of these ETFs, because they're both handled by Vanguard. So they want to have a good foundation in their ETF, and what better foundation than the Magnificent Seven, right? This has a quarterly dividend as well, just like VOO, but instead of paying $6.36, this is only going to give you $2.38 annually, right? It's still a good amount. This price of this stock is currently at $343.57. And the same thing with VOO. I'm going to wait for it to pull back a little bit before I start filling out my position or starting my position. I don't want to start my position when the market is at all-time highs, because at that point, once I start pulling back, now I'm averaging down, and there's nothing wrong with averaging down. I just rather start a little bit lower. So if it does go down lower, I'm not averaging down a lot. I'm averaging down a little bit, and then it'll be quicker to turn around. So when it's going up, I'm quicker to reach profitability than I will be if I buy at all-time highs and it starts to pull back. But regardless of where the stock goes up or down, I am planning on continually buying this stock, all the time. So once it hits all-time highs again, if it drops, either way, I'm going to be buying all of these ETFs nonstop. because this is my dividend portfolio. I mean, my ETF portfolio, shall I say. Third ETF I'm going to be investing in is ticker symbol ARKK, ARK Innovations ETF, which is ran by Cathie Wood. Year to date, it's only up 1.27%. This ETF focuses on disruptive innovation. That is their key to growth. They identify companies that are leading and benefiting from cross-sector innovations. So companies that might help technology, but it also helps consumers or healthcare. So it's touching multiple sectors, these technologies, and these sectors or innovations are things such as artificial intelligence, robotics, energy storage, DNA sequencing, blockchain technologies. ARKK, or Cathie Wood, they're focusing on investing in the future. So when the market gets a little shaky, this portfolio, or this ETF specifically, is going to get hammered. But when the good times get to going, ARKK is going to get to rolling, and it's probably going to be one of the highest growing ETFs in this portfolio that I'm making. They do not have a dividend. I do believe they're just focused on growth. I mean, they may pay one every once in a while, but it's not like a consistent thing where, you can say, oh, I'm getting an annual payment of blank, right? And they're not holding things like Vanguard is, because Vanguard is the key of low cost investing, making it ideal for buy and hold investors and retirement savers. ARKK is for growth. So if you have those diamond hands, ARKK could be for you. They're not having the Magnificent Seven in theirs per se, but they do have Tesla in there, which is one of them. So you got Tesla, they got Coinbase, Block, Roku, and Roblox. And then they have things like CRISPR Therapeutics in there as well. So they're focusing on future innovations, future companies that can explode in the up and coming years. And they're just getting in early because they see where society is going towards, and they want to be on that train early on. So they're investing in things before they get, inducted into the S&P 500 and stuff like that. Like Tesla, they were in Tesla way before they got into the S&P 500. So they're just looking ahead of, other ETFs. Fourth ETF I'm gonna go into tickers. Oh, and I'm sorry, ARKK is currently sitting at $51.14. The next ETF is currently sitting at $87.09. That's ticker symbol MOAT, MOAT, which is a Van Eck Morningstar Wide Mode ETF, currently up 2.91% year to date, right? And this focuses on U.S. companies Morningstar believes possesses a sustainable competitive advantage over its competitors, or a moat. If you know, back in the medieval times, they had those castles, and they had a big old ditch dug around it, filled with water and like alligators. And you really can't approach that castle unless they let the bridge down. That's a moat. And that's what they're saying, that these companies that they're investing in, they have moats around them, meaning that the competition can't get close to them because of the way they position themselves in the industry, right? And their holdings consist of things like Salesforce, Equifax, Disney, Etsy, Fortinet. If you don't know Fortinet, I made a video on this like a year and a half ago about how dominant Fortinet can be in its up and coming times, where everything is focusing on everything's going towards the internet, where everything is on the internet, and it's like a cybersecurity type of company. So they're considered a more medium risk in comparison to the Vanguard ETFs, and then I would say ARK is more like a high risk ETF in a sense. But Moat is more of a medium risk ETF, and they're gonna pay an annual payment one time in December, and that's of like roughly 70 cents. It varies between 67 and like 87 cents, but recently it's been around 70 cents as of recent. The last ETF I want to talk about is SCHD, and that is Schwab US Dividend Equity ETF, currently sitting at 1.9% year to date. Price is $78.15. And this ETF tracks as closely as possible the total returns of the Dow Jones US Dividend 100. It is designed to measure the performance of high dividend yielding stocks issued by U.S. companies that have a record of consistently, you hear that? Consistently. That means they're more than likely dividend aristocrats. They're more than likely going to pay that dividend out before they won't pay that dividend out. So they have a record of consistently paying dividends, right? And this ETF holds companies like Home Depot, Verizon, Texas Instrument, Broadcom, Coca-Cola, AbbVie, and it does a quarterly dividend payment as well. So every quarter you're going to get a payment. Annually you'll get $2.66 annually, right? And so those are my 5 ETFs. You got VOO, VOO, VUG, VUG, ARK, ARKK, MOAT, MOAT, and Schwab, SCHD. Those are the 5 ETFs that are going to help me build this new portfolio into a mainly dividend portfolio, helping me get passive income coming. And one of my portfolios already, I'm already getting like $40 a year off of dividends. Another one, I think I'm getting like $2 a year off of dividends. The other one, there's no dividends in that portfolio. And then I got my cryptocurrency. But this one, if I buy one stock of each one of these ETFs, all 5 of them, I buy one, I will get a total of $12.10 at the end of each year. And then all of these companies, all of these ETFs raise their dividend payments annually. So it might be $12.10 this year, but as they raise their dividends for the next year, that $12.10 might become $13 or $12.85. You see how that's growing? And then you do the dividend reinvestment plan, aka DRIP, DRIP. This is a program that allows investors to reinvest their cash dividends into additional shares or fractional shares. So when I get that $6.36 annually from VOO, instead of just it being in my portfolio, it'll automatically go right back into VOO. That $2.38 I get from VUG, instead of it coming into my portfolio just being in cash, it's buying a fractional share of VUG for me. And that's how we make that passive income. Because now you're doing compound. Like when you get a credit card and you spend it, and now you got to pay interest on there, and they put the interest, they don't say, hey, here's your interest, just pay this. They put that interest into your balance. And then the next month, say if you didn't pay all that off, now they're going to put interest on your initial payment plus the interest you had last month. That's called compounding interest. But instead of you having to pay it for your credit card, these companies are paying us the compound interest, right? And that's how compound interest works. So you got to make it work for you, right? So if you get the dividends, don't just take it out like, yeah, I got $12 what we eating for lunch today, you know. No. Allow it to compound interest. Because eventually that $12 will become $20 a year. Will become $40 a year. Then $100 a year. And as you keep continually putting money into this, then it's going to be hundreds of dollars a year. Then you'll have enough money eventually for you to buy a whole nother share. Instead of buying a fractional share with your dividends, you'll be able to buy a full share. And now each month or each quarter, you're buying a full share. Now this stock is taking care of itself in a sense, and it's just continually building on by itself. But that's what we're gonna do, man. That's how you take advantage of compound interest. That's how you get that passive income, by taking advantage of compound interest. Those are my 5 ETFs. If you have an ETF that you like and that you think I should consider placing into my ETF portfolio, drop it down in the comments. I really appreciate y'all. I love hearing from y'all. Yeah.